On October 2, 1929, John J. Raskob invited 9 powerful men to lunch at his apartment in the Carlton House. The market had already changed. Since Labor Day, the Dow had fallen about 10%. The summer's confidence had not disappeared, but it had acquired a new sound: explanations, lowered voices, calls returned quickly, and men asking one another whether the public might lose its nerve. Around Raskob's table sat people who were used to moving markets, not being frightened by them: William Durant, Arthur Cut-Ten, the Van Sweringen brothers, and others whose fortunes had been built from leverage, steel, railroads, cars, and nerve. Raskob was not blind to the danger. He had been reducing some of his own exposure. But he also believed fear could become contagious. If rich men began acting as though the future had cracked, the public would hear it. Then Raskob left the room with architect William Lamb. When they returned, they brought in a model of the Empire State Building. It was not just a building. It was an argument in limestone and steel. If America could build that high, Raskob was saying, then surely its market should not fall because men like them stop believing. This is what a bubble sounds like before it breaks: not panic, not yet, but confidence asking to be performed. 4 days later, Winston Churchill arrived in New York. He came with family, debts, ambitions, and a famous appetite for comfort. Bernard Baruch, his American friend, covered expenses and installed him near the center of the financial world. Churchill stayed at the Plaza. He used a desk in Baruch's office at 120 Broadway. He was given introductions, dinners, transport, and the kind of hospitality that made money feel less like a calculation than a climate. For weeks, he had crossed North America in private cars and elegant rooms, watching a country that seemed richer, younger, and more certain than Europe. In hotel after hotel, he noticed stock rooms. People did not merely read about the market. They sat in public spaces and watched it as a form of modern life. Churchill was not a Wall Street innocent, but he was financially vulnerable. Politics paid badly. His writing and lecture tour mattered because bills were waiting at home. Surrounded by American prosperity, he began to speculate more heavily. The important thing is not that Churchill bought shares. It is that the boom could recruit someone like him through rooms, favors, stories, and admiration. America did not have to argue very hard. It only had to invite him inside. On October 10, Thomas Lamont hosted a dinner for Ramsay MacDonald, the British Prime Minister. The guest list was small and immense: bankers, industrialists, jurists, statesmen, and the governor of the New York Federal Reserve Bank. To host a head of government was more than hospitality. It was proof that finance could sit close to power and call that closeness public service. At the table, the men spoke about peace and international order. The Kellogg-Briand Pact had promised a world where war itself could be outlawed. To the diners, it was possible to believe that modern statesmen and modern financiers were building a more rational age. Florence Lamont, listening outside the male ritual of the table, was less convinced. The optimism sounded too perfect. That doubt mattered because inside Lamont's own office, the market no longer looked simple. Russell Leffingwell, a Morgan partner with a sharper eye for danger, believed the long bull market had passed reasonable bounds. Too much credit was being pulled towards stocks. Too much public attention had turned from work to gambling. The practices underneath the boom were not clean enough to justify the confidence on top. Lamont did not want to send that warning to Hoover in such hard language. The dinner table said a new day had dawned. The memorandum said the machinery underneath was overheating. By mid-October, reassurance was still everywhere. But it had to work harder. Irving Fisher continued to defend the market. Investment trusts, in his view, were not making prices more dangerous. They were bringing the public into a broader ownership of American industry. Modern corporations, modern production, laboratories, efficiency, and national growth still seemed to him to justify high prices. The Commerce Department spoke in the same register. Industrial activity, steel, automobiles, employment, and payrolls could all be presented as signs of underlying strength. Charles Mitchell, returning from Europe, also sounded calm. The recent decline, he suggested, had done some good. It had shaken out excess and left sound securities at more reasonable levels. Each statement had its own logic. None sounded absurd in isolation. That was the problem. A bubble nearing the end does not require every reassurance to be stupid. It only requires reassurance to arrive later than the pressure it is trying to explain. Hoover heard the contradiction. From the White House, he kept turning to Thomas Lamont for Wall Street intelligence. He wanted to avoid a panic, but he also knew that silence could become permission. The president was listening for the market's real condition. What he received was a chorus of important men trying to keep their voices steady. Lamont's answer to Hoover arrived on Saturday, October 19th. It was long, polished, and optimistic. It argued that the economy remained strong, that American securities were desirable, that the spread of stock ownership might even reduce social conflict by making more citizens partners in industry. Above all, it advised against corrective action from Washington or from 23, Wall Street. Hoover read it eagerly. One of the most important bankers in the world was telling him not to be alarmed. That same morning, the market told a different story. The Saturday session ended with a sharp break. The Dow finished the week badly. Brokers had already begun demanding more protection from customers, and margin requirements that had once seemed easy were being raised to levels many speculators could not meet. This is where confidence stopped being a mood and became a mechanism. If a customer could not put up more cash, the broker sold the customer's shares. Those sales pushed prices lower. Lower prices produced more margin calls. More margin calls produce more forced selling. No one had to shout. No one had to confess that the dream was over. The paperwork did it. On the very day Wall Street's calmest letter reached the White House, the market began teaching thousands of borrowers what leverage sounded like on the way down. After the break, people wanted a person to blame. On Sunday, October 20th, the newspapers suggested that Jesse Livermore was leading a bear attack against high-priced stocks. It was an old kind of story. If prices were falling, perhaps a powerful speculator was hammering them down. Livermore was first startled, then angry, then practical. He invited a reporter to his office and made the room part of the performance. He denied leading any group. He also said what bulls did not want to hear: prices had become ridiculous. His challenge to Fisher was not academic. Fisher spoke from the authority of a professor. Livermore spoke from the authority of someone who had survived speculation by treating the market as stronger than opinion. Then Mitchell returned to New York. Reporters met him at the dock, hungry for calm. He gave it to them. The decline, he said in effect, was healthy and perhaps already overdone. If the fundamentals were sound, there was no reason for alarm. But in the same breath, he wanted easier credit. A lower rate, he argued, would help business and restore prosperity. The contradiction hung in the air. If nothing was wrong, why did the system need relief? By October 22nd, reassurance was no longer a confident announcement. It was becoming damage control. On Wednesday, October 23rd, the market opened and then began to fall through its own explanations. The selling hit major industrial names, not just speculative favorites. The pressure moved across the exchange, the curb market, and over-the-counter trading. More accounts were called. More positions were sold because they had to be sold, not because their owners had decided to leave. Near the close, trading became so heavy that the ticker could not keep up. The machine that had made the boom feel knowable was now late in reporting its own unraveling. That delay was more than a technical failure. It changed the emotional weather in every customer room. If the tape was behind, then the price on the board was not the present. It was the past. Every investor was looking at information that had already expired. Some professionals tried to find comfort. Bond dealers saw money returning to their world. Bankers muttered that people who had abandoned their work to sit in brokerage rooms might now be forced back to ordinary life. But the larger fact was simpler. The market had stopped absorbing bad news. It had stopped trusting reassurance. It had stopped moving at a speed the public could read. The crash had not officially arrived. But by the evening of October 23rd, the sound had changed completely. The rooms were still there. The telephones were still ringing. The important men were still speaking. And beneath them, the floor was beginning to give way.